What is going on, investors? Hopefully you guys are doing well out there, and it is time for FANG earnings. We only get this time 4 times per year, and we're going to make the most of it because we got Netflix reporting after the bell today. And I tell you what, these are very, very impressive numbers. We'll walk through some of the things that maybe were missed on kind of the top line press releases. We'll go through the numbers. I tell you what, these numbers are fantastic. The guidance, it's pretty darn good as well. We'll take a look at the different regions that the company operates in. We'll look at the high-level financials, the balance sheet, the cash flows. We'll come over here and look at it from a technical perspective. If you follow our Friday recap show, we do look at the technical chart pattern of Netflix every Friday. And we did note that it kind of broke through a trend that has really been building for about a year or so. Not that big of a deal when you break an uptrend. It's not the end of the world, but we'll talk about what this means as I've put in a fake Greek candle, because as we see in the after hours, shares of Netflix are popping up over 12% in the after hours. That's something that can float around. But look, year to date, even after being down today, shares of Netflix up 20% over the last year. Shares of the streaming giant up 43%. The company reported their Q3 earnings after the bell today. Revenue coming in at over $8.5 billion. That was 7% growth on that top line. If you exclude the fluctuations in foreign currency, you get about an 8% growth on that revenue. Now, here are some things that probably didn't get talked about is they upped their full year 2023 free cash flow guidance to $6.5 billion. Previously, they were forecasting $5 billion. So they've added $1.5 billion to there. They've repurchased 2.5 billion shares just in Q3, and they increased their buyback authorizations by over $10 billion. So despite shares of Netflix climbing 43% over the last year, company believes that there is more growth to come. And maybe some of that has to do with the fact when you look at these financials, man, they blew it out of the park. We talked about how they had $8.5 billion worth of revenue. That was about 8% growth minus constant currency. We'll go through the financials more here in a second, but here's the real thing. Your global streaming paid memberships, boom, exploded up over 10% in the most recent quarter. And look at the trend that you've been going on. 5%, 8%, now 10%. They don't give us a guide on subscribers anymore. But I tell you what, that trend is fantastic for the company. And they also showed you that they reduced the number of shares outstanding as well. So you are getting massive growth in the United States, a re-acceleration, particularly over the last 2 quarters, and a continuing acceleration of paid net subscribers. They're not squeezing out that much more on that average revenue per membership. I think that's really where the ad tier comes in the Europe, Middle East, and Africa. Also, another re-acceleration of that subscriber growth, which really is what this is all about. It's subscriber growth combined with price. Down in Latin America, also not quite as good as last quarter, but still strong subscriber growth, relatively constant on that revenue side. And then finally, Asia Pacific, also very strong, consistent growth there. Now, the company did announce some price hikes as it had some of its best subscriber growth in years, which we showed you off the jump. They're going to raise some prices of some of the tiers, but they still have that advertising tier starting at about $6.99 per month, which is towards the low end, I think, based on the quality that you get and the choice that you get for Netflix. Not that I'm tuning in a ton, but I think $6.99 sounds like a relatively good deal based on Peacock and all the other ones that are out there. Talked about how revenues came in at $8.5 billion last quarter. They were at about $8.2 billion last year. They were closer to $8 billion across the board on the cost side, relatively in line with basically where you're going with that revenue growth. Look at what they did. They actually spent less on marketing year over year, quarter over quarter. They actually spent less on marketing to drive higher revenues. That's fantastic. Still spending a lot on tech, but it's in line with where you were last quarter. It's actually down year over year. More on the general administrative side. Some of this could be the launching of that ad tier. Maybe you've got to roll out some new employees, some new sales structure, those types of things. Your operating income coming in just south of $2 billion. That's more than you were a quarter ago. That's about $500 million more than you were a year ago. Companies pumping out positive net income. So what that's allowing them to do is stack up some cash on this balance sheet. Look at your cash equivalents over at Netflix, over $7.4 billion, another $5 in short-term investments. Total current assets sitting at about $10.8 billion. This is a content company. They're sitting on about $32 billion worth of that. Company does have some long and short-term debt, about $14 billion. But if you move across the industry, not really that alarming, considering also when you look at the 3-month ended in the most recent quarter, company generated nearly $2 billion of operating cash flow. Operating cash flow is the amount of cash that you generate after you minus things off like stock-based compensation, foreign exchange rate, losses, content assets. You got some weird accounting that you have to do from a content company. This is a strong number. Last quarter, you were at $1.5 billion. Look, last year, you're at $500,000. Here's where they repurchased $2.5 billion worth of stock over the last 9 months. They've repurchased about $3.5 billion. And then they talked about how they've increased that buyback by another $10 billion. So the company is going to be taking a lot of this cash flow and then really using most of it, in fact, to buy back the shares of the stock. Company from a balance sheet perspective has the option to do that. And as they roll out these price hikes combined with subscriber growth, well, the cash flow might actually get even better. In fact, the company telegraphed that, upping their guidance by about $1.5 billion on that cash flow side. Now, from a technical perspective, we talked about this company has been in an upper channel making higher highs, higher lows, beautiful channel. We decisively broke through this trend. What often happens is these trends, you actually kind of back test the underside of it. Happens also when you blow off the top of these trends. You often want to come back and kind of back test the top of the trend. In Netflix's case, back testing the trend would take you back into kind of that $400 range, $420, $430 on the share price. It's a pretty heavy area of consolidation. I would expect sellers to step in on Netflix at those levels. Wouldn't necessarily be a buyer at today's prices. You get a further or another leg lower for Netflix. It's probably where your buying opportunity is. I have a red line in here at about $280 per share, but really anywhere from $300 to about $250. That's where I'd actually be targeting Netflix shares. Again, despite the increase in their forecast, despite the increase in prices, despite the fantastic subscriber growth that they've really experienced over the past couple of quarters, you're likely heading into some headwinds as you had that long writer strike. I believe the actors are still on strike. So this is a company that as we start to lap that, as we get into next year and the following year, there's probably going to be some content gaps there, and that could create some pressure on the company from a content perspective. But this is a fantastic report. The technicals don't really change, even though you have a massive move over 12% in the shares in the after hours. It really doesn't change a whole lot. You have broken trend. You are likely going into either consolidation in that sense, or you're going to move lower. I would wait until you get confirmation there. Wouldn't rush into Netflix despite the strong numbers. We'll talk more about it on Friday when we do our FANG Stock recap show. Until then, I hope you all have a wonderful week. We'll see you again Friday, and good luck with your investments.